Well, let's get across the market open. David Scott joining us from City Index. Scotty, great to catch up with you on this Friday. Let's start stateside. Hotter than expected inflation print, whereas seeing some weakness there in the jobs market. How do you make that, particularly what markets made of that data?
Yeah, it was interesting. I think that everyone knows that when it comes to the initial jobless claims data, the biggest increase that we'd seen in a year was largely due to temporary factors. We know that it was Hurricane Helene. We're going to see the impact of Hurricane Milton coming through in the data next week. So we'd all expect to go and see a pretty big increase, but it was obviously bigger than anyone expected. And that acted almost like, as a contra to what we saw when it came to the inflation report, which of course that core CPI report reading at 0.31% month on month was a little bit too hot to handle. So for the time being, it was kind of they offset each other. But I'm not really surprised to see the market reaction because we're at very, very elevated levels. We're approaching earnings season as well. And now we have the threat, of course, that if we see this continued pickup in inflationary pressures at a time when maybe the labour market's starting to weaken again, that's not a good scenario when it comes to risk appetite.
Yeah, of course, we've got further commentary from Fed members overnight as well. Interesting, Raphael Bostic saying, I'm totally comfortable with skipping a meeting if the data suggests that's appropriate. What's that telling you?
Yeah, well, obviously, he went and acknowledged as well that he only had one further 25 basis point cut in his profile for 2024. So he's clearly one of the more hawkish members of the FOMC. But it's interesting because we've seen the data, the jobs report that came out last Friday, even excluding the payrolls figures, which I'm still not a big fan of at the moment. The unemployment rate nearly fell to 4%. So that's going backwards. That's down from a peak of 4.3% a couple of months earlier. And then you look at what's going on when it comes to the inflation print as well. We've seen now two back-to-back 0.3% increases for core. Yes, it's not the Fed's preferred inflation measure, but that is uncomfortably high. You annualize that out, 3.6%. That's way too hot to handle. So I can understand why Bostic is going down that path. Michelle Bowman, the sole dissenter from the September FOMC, she speaks later on this evening, and I'll be really, really interested to see what her thoughts are because see if she can convince some of those other FOMC members to maybe join her in the no-cut camp.
Scotty, let's refocus then on China. Kicked off its swap program aimed at supporting the stock market yesterday. We're going to hear more on Saturday. What do you think we're likely to hear?
Probably a lot more of the same kind of announcements. We're seeing incremental increases in stimulus. I know that there's a lot of excitement now. You talked about that swap program just then. That was announced last week, but the fact that it was put into implementation yesterday was enough in itself to go and get the markets really, really excited. So you can imagine today it's going to be another kind of day where we see a lot of anticipation and probably a lot of excitement about what the MOF will go and announce on Saturday. But I've heard anything ranging from 2 trillion yuan to 10 trillion yuan. That's 6% of GDP at the top end of the range. It's just way too much to what the reality is. China's economy is not falling off a cliff. They're trying to go and stabilize growth at this point in time. So I'll be looking towards maybe the smaller end of that scale, and potentially I'd only really change my tune and get excited about the demand side if there's actually structural changes to go and boost demand. And I don't think we're going to see that. I think we're going to see more incremental supply side reforms coming through to try and juice growth as we've seen in the past.
Well, of course, markets ever hopeful, particularly given what we've seen on local equity markets there. What do you make of those moves?
Well, when it comes to the Chinese equity market, mate, you'd be better off going down to the casino and trying to do some technical analysis on the chocolate wheel, because right now in Chinese markets, it is not untradeable. Nothing is untradeable, but it's all about momentum and momentum swings. You can't trust price signals whatsoever at this point in time. You don't know when the national team's in at this point. And we know that's having spillover effects to other markets across the region, including our material space. We're seeing the iron ore price. It trades almost in lockstep with Chinese equities, particularly the Hang Seng Index over the course of the early parts of the session. So that's one trade you can go and look at if you're a jobber and you want to go and try and do things on an intraday basis. But I'm looking forward to the period where we actually get all the information, all the stimulus is announced, and then we can maybe go and settle down and try and read into the price action. But right now, it is pure speculation, and beware getting too caught up in the hype because it's been seen time and time again, and we're seeing lots of disappointment since the GFC.
Yeah, indeed. Well, there is plenty of hype, as you point to. Scuddy, locally, what are you watching for here in Australia?
Yeah, look, again, it's going to be the Chinese equity market. It's going to be very influential in the early parts of the mainland session, so about midway through the session for us. Uh, Look, when it comes to the directional shifts, there's not a lot to go on. SPY futures are almost flat. We didn't see a lot of movement last night in US markets as well. Yes, there was a small decrease coming through, but will that translate to our market? Probably not. And when you look ahead to the next week, that's what I'm starting to do right now. I'm looking at the calendar coming up. There's US retail sales, but there's not really a lot more beyond that. And given the move we're seeing in yields, given the strength we're seeing in the dollar, and given the fact we're likely to see some temporary weakness coming through in some of those labour market indicators, I think maybe we'll see yields going pull back, the US dollar pull back, and potentially see a drift higher in risk. So potentially today, I'll look for a bit more upside ahead.
All right, how are you seeing the Aussie tracking at the moment?
Yeah, Aussie's been absolute belted, and that's purely because what's been going on with the rates recalibration in the United States. What we're seeing is US two-year yields have been lifting higher, the US dollar's been powered higher by that, and almost in lockstep, the Aussie's been falling in line with that. So keep a really close eye on short end US yields. It's been really influential on directional shifts in the Aussie. So if yields do keep going higher, it's a safe bet at this point in time that the Aussie's likely to go lower.